Hey everybody, Matt Weber here with Alpha Funding. I'm here with David Zohn. David is actually one of our term underwriters, and we're going to be going over a very exciting topic today, one that has become so popular and used in the real estate investment world, and these are called DSCR loans. A lot of you hear the word DSCR, and you may be asking yourself, what does that mean? We're going to go into that today. Most simply, when you are a real estate investor and you're looking to hold on to a property long term, or if you're refinancing out of a hard money loan, you're going to most likely need one of these, what they call a non-qualifying mortgage or a non-QM loan. Non-QM just simply means it's not a traditional loan. It's a non-qualifying mortgage. We're going to give you an alternative to going to a full doc traditional conventional loan. And some of these loans are really impactful because of many reasons, but we're going to go through them today. So I want to quickly introduce David. David has been working with Alpha for over 5 years now. He's one of our term underwriters. He specializes in these loan programs. So we are going to be unpacking a ton of info for you today. And I'm really, really excited. David, welcome.
Thanks, Matt. I appreciate that great introduction. Always kind of you, and always great hearing how long I've been with the company and how much we've grown since I started. I love it.
Yeah, so let's get right into it.
Yeah, so like Matt said, we are looking at DSCR loans and giving you the opportunity to look into these long-term loans. One thing that I do want to point out are what DSCR actually means. And so DSCR is an acronym for Debt Service Coverage Ratio. What does debt service coverage ratio mean? It means how well a property performs compared to its total monthly expenses. And when I say performance, I really mean how well the property is cash flowing. We have to look at the cash flow. We have to look at the income. And what target metric are we looking for that income? It's going to be at least 10% above those monthly expenses. So it's going to be a 1.1 ratio. 1 meaning you're even, 0.1 meaning the extra 10% over that expense ratio. Now, why are you going to consider a DSCR loan, right?
So whenever an investor is looking to use a DSCR loan, there's many reasons why you would select a DSCR loan versus maybe potentially a conventional or traditional loan product that's out there. One of the main reasons is you have the ability to utilize your business entity. So you can get one of these loans, whether you're going to be buying a rental property and you're just getting you're purchasing the rental property, or maybe you're refinancing that rental property out of an existing loan, maybe a hard money loan, bridge loan. You can do it in an LLC. There are many reasons why you'd want to do that. A lot of it is because of tax sheltering purposes, right? We always talk about asset protection. You want to protect your assets. You don't want to also put yourself in harm's way by having your loan in your personal name. There's a lot of risk, a lot of liability that can come with that. So having it in an LLC, that is a major reason why you would also have it in a DSCR loan. Also, the property is not going to be showing up on your credit report. So when you get this mortgage, it's not going to show up on your DTI. That is extremely important. Many investors have multiple holdings in either a master holding LLC, which is a whole nother topic that we can go over in another AlphaU module. But if you're going to be holding multiple properties, you don't want them to show up on your credit report because that's going to hurt you down the road. So not having it show up on your credit report is very, very, very critical. And basically, it makes it impossible for you to be over leveraged. And that is the reason why so many of our investors and so many investors in general purchase rental properties and they put them in some sort of an entity, because obviously it shows not on your personal credit and you can hold it in an LLC for asset protection purposes. While your credit is utilized to determine possible leverage, it will never report there. And the loans are written for you to succeed. And one more reason why you would potentially use a DSCR loan is because of the nature of the loan. This is a private loan. This is not a traditional, like a federally backed mortgage. It's a lighter doc loan. So you're not having to put up so much documentation. When I got my FHA loan from my multifamily, I had to go full doc. I had to show my pay stubs. I had to show tax returns. I had to give them a ton of information. This is a light doc loan. So when people say, is this a no doc loan? This is not a no doc loan, but this is a very light doc loan. So you'll hear that term, light doc or low doc loan. When you simply, David, you obviously, whenever you're getting these loans in, you're simply asking for, and just correct me if I'm wrong, you have bank statements that you're requiring. Obviously, we need to see the corporate documents. So your LLC formation docs, your EIN number, your obviously personal information. We do need to see your driver's license, but for the most part, you're basically looking at the property itself and how it performs. And then we're getting some information from you and from your business. But generally speaking, you know, it's based off of the performance of this property. Do the rents cover your payments? And if they do, like you said in the previous slide, by more than 110%, you have a plus 10% cash flow, then you can qualify for a loan like this. Is that correct?
That is a majority of correctness right there, right? I think one of the most important things that's often overlooked is the ability to utilize your credit. And I think a lot of people will see this and say, well, you said the property's performance is really going to dictate the options that you give me. That's mostly correct. The real challenge is here is that we also have to look at the borrower's personal credit, right? We have to look at the mid score, and that's going to be a guiding factor. So no matter what, you could have the best cash flowing property ever, but if you're not qualifying from a credit standpoint, even though this property and this loan will not show up on your credit report, it's still going to be a very determining factor. And we'll get to that very soon. So right now we have a few different trends in the market, something that we've been looking over from a macro long-term and a micro short-term. There's been a lot of rate volatility. We see rates going up and rates going down on a daily basis. It's really hard to lock down, and rates have definitely increased over the last year, last 360 days. One thing we will always keep an eye on are the current rates. And whenever somebody's coming for a quote, whenever somebody's submitting a deal, we will always try to take the best rate on that day to try to lock it in and make sure we keep that low rate for you as long as we can. Now, when we are looking at these different rates and the trends in the market, we also have to look at, like I said earlier, your credit score, your FICO score, the available leverage that we can give you, the seasoning of the property. If it's a refinance, we have to make sure that you've owned it for at least 30 days for a rate and term refinance and 90 days for a cash out refinance. Do you have enough cash on hand to cover the closing costs? If you're not taking cash out of a property, you might have to bring some dollars to the table. You might have to pay some legal fees. You might have to pay some title fees. There might be back taxes you have to catch up on. And then the type of asset class is also really important, right? There's going to be different constraints, single family versus a 10 family or an apartment building with 10 units, right, Matt?
Now, what you were talking about with current trends in the market, I want to make sure that, because if you're watching this video now, or if you're going to be watching this video a year from now, looking at this from a big picture perspective over the last, markets are cyclical. The rates have changed. When we were back in 2018, 2019, prior to COVID, you saw that rates were in the 6-7% range. And then you saw that race to the bottom, and you saw rates going down into the 4s, the 5s. And then all of a sudden from 2022 into the last year, 2023, our rates have jumped up. What is really, really important for you to know is that this product is very, very attractive. If you're a real estate investor, our rates, which right now in its current form are probably in the 7s and the 8s and the 9s right now. But if you go to a traditional loan, now we're talking about this is in September of 2023. The 30-year fix is in the 7s right now, a full doc owner-occupied loan. If you're going to buy a home to live in yourself, not an investor loan, because investor loans are actually more expensive. There's higher risk. It's more expensive. Even a owner-occupied loan are in the 7s right now, and we're offering some rental loans in the 7s and 8s. So just always understanding, making sure that you know the data. A couple of years ago, rates were in the 4s and the 5s and the 6s. Rates have slowly gone up, but when you look at it in comparison to a traditional conventional loan product that is out there, It is a light dock loan. You're still getting tremendous leverage, and the rates are very, very competitive to a conventional loan. So just understanding that, and also knowing that rates are going to change. And we're going to talk more about that in this section.
Yeah, I think one benefit we could also throw on top of there is the speed in which we can close. Generally the turn time for closing these loans, depending on the asset class, is between 21 and 45 days. That 45-day mark usually is usually for the commercial properties, anything over 4 units, just because of the turn time of the appraisal. But when you have speed on your side and the rates are going to be volatile, you want to have that speed and ability to close quickly. So what are the expenses that you're going to need to consider as part of the DSCR, right? We look at income versus expenses. We look at the monthly taxes. We look at the monthly insurance. If there's a property management fee, let's say I'm located in New Jersey and I'm trying to do a property in California. Am I going to go there every single month or every couple of months to do all the maintenance and management? No, I'm probably going to have a third-party management company handling it for me. If there's any maintenance that needs to be done, what are you budgeting for that? And then we have to look at the new monthly principal and interest of the loan. All those things together is going to help us give the expense side of the DSCR calculation.
I think that's so important what you just said, because so many investors, I think they have beer goggles sometimes for their own properties, or if they're excited about a potential new opportunity, they're just like, I just got to make sure that I have my taxes, my insurance covered, and what's my payment going to be? And they don't understand that there's a lot more that goes into this. So David, obviously, you have a expert here on the call. We're going to go over why it's not just so simple. It's not just your principal, interest, taxes, and insurance. You have to look at everything. There's a lot more costs that are included. And that's going to obviously affect, is your property truly a cash flowing asset for you?
Right. As much as people would want to include, people, including myself, I should say, want to get the best deal possible and get the highest amount of cash, put as little money down as possible. Sometimes if you get higher leverage, you could be leveraged out and not actually cash on the property. Why would you want to own an investment property where you have a negative return on investment every single month?
What are some things that you think that investors may overlook when they're going, like you obviously you work with hundreds, thousands of investors that are looking at rental loans. What are some costs, hidden costs, that you see some investors don't account for when they're doing their calculations, their analysis?
I could think of one in particular that is often overlooked. People will take their home insurance or their renter's insurance, whatever they're paying where they're currently living, and they'll apply that same metric to their investment property. And they'll say, wow, I'm only spending $1,200 a year on my own primary residence, so I could assume that I could cover this investment property maybe a little bit less and pay $1,000 a year to $1,200 a year. The big thing that is overlooked there is that assuming that the coverages are exactly the same and that they're going to be the same price. If I could give any recommendation when it comes to insurance in particular, find an insurance agent, a brokerage, a company that knows how to work with real estate investors, knows the requirements, knows how to protect you. Because while insurance could be expensive, it could be cheap, the type of coverage does matter as well.
Love it.
And in terms of hidden fees, hidden expenses that are often overlooked, I think I just went over them in full, and I'll go back to the slide. These are really things that you want to try to narrow down on. You
know what? I was just thinking about one. What about the case of potentially building in a vacancy? Who knows if there's ever going to be a vacancy? It's not guaranteed that you're always going to have a tenant in place. Making sure that you have potentially maybe a little bit of a nest egg, a little bit of capital that's set aside. So if you did have to turn over a unit, whether it's 1 year or maybe a couple times in a given couple years, making sure that you have those dollars available, because you may not have your unit occupied at that time.
Yeah, that's a really good point. I think when we do our calculations, when I look into everything on my end, we don't necessarily need to consider the vacancy for our expenses, right? But it's also good for an investor to know that setting maybe 5% a month aside would be good as a little nest egg, as a little protection, just in case you do have some lapse between your two leases, or
Very
maybe even more.
Mhm.
That's a great point, Matt. Thank you. So let's get over to the program overview of what we're looking at now. Right now, with today's rates, and like Matt said, you could be looking at this a year from now, maybe 2 years from now, but as of September 19th, 2023, we have rates starting at 7.75%. The asset classes we cover are single family, multifamily, 2 to 4 units, commercial multifamily, 5 to 10 units, and then commercial mixed use as well. The one thing to note is that commercial mixed use is much different from a commercial multifamily. And Matt, you know about this, right? What's the difference between a 5-family, or let's say a 7-family, and a 3-family with a commercial component to it?
It's the zoning. So if you have 7 multifamily apartment dwellings, it's going to be commercial multi, but as soon as you have one commercial space, it's going to be considered mixed use.
Right. And a commercial space will be anything that's listed to a commercial tenant, right? So if I had a tenant, and let's say Matt was my tenant, and he signed the lease as MW LLC, that would be considered a commercial tenant. And we can't accept that on a non-commercial property. So
Now,
we have to make sure that the property is specifically zoned and underwritten as that asset class.
Now, a lot of people will ask me on a daily basis, if I do have a commercial multifamily or I do have a commercial mixed use, is there a minimum loan amount that has to be satisfied? Because sometimes in different areas of the country, property values will vary. Is there a minimum for your commercial multifamily and mixed use?
That is a great question. And yes, there is a minimum. We have to have a minimum loan amount of $250,000 for any commercial multifamily or commercial mixed use property. Right? So geographic region aside, wherever it is, we would look for at least a minimum value on these commercial and commercial mixed use properties of around $335,000.
Okay.
Right? Because we look at 75% LTV, we try to get that $250K loan amount. So we'll be right in that sweet spot right there.
Beautiful.
So aside from the commercial multifamily and the commercial mixed use, the single family and the multifamily up to 4 units, we could go up to 80% LTV based on the as-is value of the property. Now, there is a caveat with that. Let's say you're purchasing a property and the property value is $200,000, but the purchase price, you're actually getting a good deal at $190,000. Matt, in your mind, what do you think we would lend off of?
I would believe if the as-is value came in higher than the agreed upon price, we're going to go off of the as-is value.
I wish I could agree with you there.
No?
No. So the real trick is, if you're getting a property for $190,000, you're buying a property and the value is higher than what you're getting a good deal. But we cannot lend off of what it's worth. We have to lend on the lesser of the purchase price and the as-is value.
Does that also count for refinances?
Well, that's a little bit of a different situation, because you're not going off of 2 different competing values with the refinance. When we're looking at a refinance, we'll always look at the as-is value.
Okay.
There's no purchase price to compete with it, right?
Mm-hmm. See, this is why I have David.
So what do you need to know as an investor coming into this loan? There's going to be a prepayment penalty on these loans. Typically, the standard in the way that we quote is going to be in a 5-year, 5, 4, 3, 2, 1% prepayment penalty. Now, what does that mean? That means over the course of the first 5 years of the loan, no matter the loan type that you do get, and year 0 to 1, for you to pay down extra, for you to pay it off early, you're going to have a 5% penalty. So let's say you wanted to pay down an extra $100 a month on your property. Instead of $100, you'd be paying $105 because of that 5% penalty. Now, let's say in year 4, the penalty is down to 2%. You wanted to pay down an extra $100, you'd be paying $102. Year 5, $101. The extra 1% right there. Now, after year 5 is complete, and after any prepayment penalty is complete, you would then go to a 0% prepayment penalty. And what that means is that you could pay down the balance, or you could refinance, or you could sell the property without any penalty and nothing due back at all. You're free and clear to go. Now, people today are not so enamored with the 5-year prepayment penalty. Why would they want to lock a rate in for a long-term basis and have a penalty that's saying, I can't do anything with the next 5 years? What if the rate goes down? Doesn't mean you can't do anything, but we also have other options available. We have 4-year, 3-year, and 1-year prepayment penalty options available. So if you do feel like there's going to be a shift in the rates, you do feel like you're going to sell soon, whatever it might be, we will have options, and we will custom tailor each loan scenario for you and your investors.
That's very, very important to take away there. So if you are an investor, depending on what your strategy, what your plan is, you have options. You're not stuck with a 5-year prepayment penalty. That may get you the most attractive rate. But if you're looking for options and you want to have some more flexibility, you have these other prepayment penalty options available.
So another thing that you need to know about are the different closing costs that you're going to be responsible for. Now, without going into too much detail, these closing costs all include the origination fees that are due to the lender, the attorney fees that you could be taking in via your attorney for purchasing the property, but also the lender legal fees that are due to the attorney that is used to actually legally close the loan in whichever state that we're going to be operating in. Title fees, generally 75 basis points to 1% of the total loan amount. If you do not have a good title company that you like working with, I suggest you find one. You could always reach out to our team as well, as we have amazing teams that we do work with. And then finally, your insurance is going to be paid 1 year in full at closing. We don't accept 6-month payment plans. We don't accept 1-month payment plans. It has to be 1 year paid in full at closing. And it could be done before closing, but as long as it's done at closing or beforehand, we're good. Now, the last thing that you're going to need to know with all the costs that are going to be associated are the escrows. We require typically 3 months of escrowed principal, interest, tax, and insurance payments. So let's say your total principal, interest, taxes, and insurance was $1,000 a month. At closing, we would take $3,000, put that in an escrow, and then the first 2 months of your payments will actually be taken from those escrow accounts. So for the first 2 months that you have any of these loans, you're not making a single out-of-pocket payment. That's pretty advantageous, don't you think, Matt?
I think so. And I think that's very important for people to know, because I think sometimes people think that, if I have to bring extra liquidity at closing, they're like, well, why? Well, understanding that this is actually going to help you. It's also understanding from the capital standpoint, this type of a loan requires this for you to be able to, you have to always take the positives with the negatives. I would actually say that this negative is actually probably a positive, but if you're looking at the pros and cons of a loan, you're getting all these benefits. Part of it is that you're going to also put up 3 months of your payments up in advance, and then you won't be making a payment for a few months, which is actually a really good thing.
Yeah. And just to finalize on that, we take 3 months escrows. The first 2 months are going towards your first 2 month payments. And that third month is actually held in perpetuity for the life of the loan. So let's say you sell, you do whatever you need to do after 6 or 7 years. Those escrows, that remaining 1 month is going to be returned to you at closing. All right, so a little bit more. Now, there are properties all across the country. There's a lot of investment opportunities, but we do have ineligible property types and types of loans that we can't make. So I think the most important thing is we cannot refinance a defaulted loan. Let's say I went into a fix and flip loan. I completed the work, but I'm currently in default. I would not be able to get my property refinanced until I catch up on the default or get that cleared. So it's very important. Property types that we can't lend to: cooperatives, any type of co-op. This happens a lot in cities. Any type of mobile or manufactured homes, anything with a VIN number, anything that doesn't have a permanent foundation. Any type of condo tells as they're known, or any type of timeshares. Anything that's raw land. We're giving you a DSCR loan based off of an investment property. Anything that's raw land can't have a tenant, can't have a property. It needs to be already developed. No single room occupancy, meaning that, let's say, Matt, I'm going to buy a house from you tomorrow. And in that house, there are 3 bedrooms and there's a separate lease on each bedroom. That would be considered single room occupancy. Boarding houses also fall under this, as well as any type of specialized properties. Specialized properties also include assisting living facilities, nursing homes, halfway houses, anything that would be considered, beyond the normal use or special use.
Now, also, you may be getting into this in one of the next slides, but if someone is bringing a property that may be in an area where there's not a lot of population, it may not be very densely populated, it's considered maybe rural, can that also present a challenge?
Yes, rural properties definitely do come and have us facing challenges. They're not impossible to do, but the real challenge is that we need to find comparable properties. And we usually look for at least 3 comparable properties within 3 square miles. We can go up to 5 square miles on a case-by-case basis. If we can't find these, then the property is not guaranteed to be fundable.
What would be for an investor that maybe has a rural property or is maybe a little bit concerned that it may be considered rural? What are some things that investors can do to see if it is rural or not, aside from reaching out to us?
I think the easiest thing to do after reaching out to us is agreeing to go ahead and order the appraisal. If you can't order the appraisal, we'll at least find, backed comps and actual evidence of that. If you do not want to take the appraisal, because I could understand the appraisal route and you want to save a little bit of money, you could always do some research and find comps yourself. You could also reach out to your local real estate agent or somebody that you know in the area to help you find those comps.
Beautiful.
I would be worried though. Make sure any comp that is provided, if you are going to look up comps yourself, are either recently sold properties or recently rented properties. Active listings, unfortunately, cannot be counted. See that happen more often than not.
Because I guess they're not concrete, right? It's speculative. It could potentially not actually happen. And we can't go off of hypotheticals.
I could list my property for $300,000 that I'm selling, but the next best property is sold for $220,000. Do you think I'm going to get any offers? It's possible. It really is. But is it going to be definite? We don't know that until the appraisal is ordered. There is a chance, but just be very wary of how you approach it. And if you want anything that is concrete, the appraisal is the best way to go. All right, so we have different types of loans for the DSCR program. We have purchase loans, where we could go up to 80% LTV. That's 80% of the lesser of the purchase price or the as-is value. We could do a rate and term refinance. And generally speaking, a rate and term refinance will be refinancing a previous balance of a previous loan without the balance exceeding, and by balance, I mean actual cash out at closing, exceeding 5% of the proceeds. And then we can go up to 80% LTV on that. I will follow up with this in a second. The cash out refinance. Any refinance where the borrower is taking greater than 5% proceeds after closing. Now, this could be paying off a previous balance and still getting cash out after closing. And what we're looking at really is not only the payoff amount, but also the closing costs, including any type of origination, lender legal fees, any escrows, anything like that. So let's say your payoff is $100,000, the total loan amount is $120,000, and then fees are going to be around $5,000 or $6,000. That would be considered a cash out refinance because you're going to ultimately be seeing $14,000 in your pocket at the end of the day. Now, let's say the loan amount was $110,000 on $106,000 total, on $100,000 payoff and $6,000 in fees. You're taking in $4,000 in cash. That could be considered a rate and term refinance.
So I think something that's very important is sometimes properties don't need work to be done. Like there's no improvements that are truly necessary. You can buy it almost like it's turnkey and just get tenants in place. Or maybe there's tenants existing and you just want to buy the property and just now operate and manage that property. So we have options where if you don't need to go the bridge route, you don't need a construction loan, you can go with just a purchase loan and you can get up to 80% LTV, which is incredible. And then if you do need to decide, or if you need to refinance out of your bridge loan, you did the construction, you've improved the value of the property, or maybe just you've owned the property and you're looking to refinance, there are these options available.
Now, let me ask you a question, Matt. If I needed to do any rehab or repair or construction on my property, would I go for a purchase loan?
No.
Why
And the
not?
reason, and you've told me this many times, you cannot, unless, and the key word is stabilized. So we'll go over that right now. If a property is not stabilized, it does not qualify for these loans. So if a property is in need of work, that work needs to be completed before we can then qualify for one of these loans. Is that correct?
That is correct. So any type of rehab that needs to be done could be done via fix and flip loan initially, which we do have options for. And then after that fix and flip loan, or as soon as the work is completed and you do get a tenant in the property, we can do an in-house refinance. We could do a rate and term refinance if you want to leave your equity in the property, or we could do a cash out refinance if there is enough equity to take out and tap
Yeah.
into.
Now, what I will say to any of our investors that are listening and watching this, there's a difference between stabilized, and I think there's a word that I want you guys to all understand is it rentable? Is it rent ready? Can you literally put a tenant in and let them, would it qualify with the inspection? Is it habitable? Can they rent it out? Can they occupy that space? If you wanted to pull out the carpet and you wanted to make it hardwood, could you potentially do that while somebody's, maybe you have a tenant, or maybe you're going to wait for a tenant to leave, their lease is up, and then you're going to change the carpet to hardwood. The big distinction here is if it is inhabitable, it is not stabilized and it doesn't qualify for these loans. If you're going to make minor improvements as a real estate investor, as a landlord, there's always going to be improvements being made. The key is this habitable? And that is the big thing. And when we hear the word stabilized, that's what I want you guys to think about.
Yeah. Now, let me ask you another question, maybe along the same line. If I wanted to go in and paint the property before I got a tenant in there, could I do a purchase loan?
Well, due to our requirements, I believe they have up to 30 days to get that completed, right? So within the
Yes.
first, they would have to
We
do that.
usually like to see a lease within 30 days of you buying the property. And if you wanted to do some light cosmetic work where the property was already rent ready, maybe get a new appliance in there, maybe repaint a bedroom, that is completely fine, and we can still move forward on the purchase loan.
That's very, very important. That's a great point.
Thanks. No, I really appreciate the knowledge that you have here too, because I wouldn't be able to do any of this without you.
Thanks, bud.
All right. So now, if we're going to be underwriting a term loan, if I'm going to be underwriting a loan for you, and we're going to be looking at a certain scenario, we're going to go through one right now, but I'm going to look at credit first. And we have different credit boxes. I'm going to go over credit boxes in following slides, but we look at credit. I look at the DSCR, making sure on a 30-year fixed rate mortgage, it's going to be a 1.1 minimum. And on any of our interest-only arms, we're going to look at a 1.2 minimum. We look at the rental income and expenses. That's also part of the DSCR. We look at the property value. How much is the property currently worth? And then we look at the property class. Is it a single family home, a 2 to 4 unit, a 5+ unit, 5 to 10 units, or is it a commercial mixed use CMX? We also look, as you said earlier, and we touched on earlier, the geographic area, whether it's urban, suburban, or rural, because all those are going to factor into our ability to find comparable properties and get the best possible value for your property. Then we look at occupancy. Are there units rented? Are they vacant? Are they currently owner occupied? Is the tenant vacating at closing? And one thing I will note right here, we have a lot of people who are looking to buy properties. And a lot of people think that they're getting good deals. until they find a deal so good that the tenant won't let them get into the building. Why do you think that's going to be a problem, Matt?
Well, I mean, if you're unable to get into the unit, I guess it would be probably the appraisal, getting the valuation.
Yeah, how are we going to get an appraisal? We need to have full interior access for that appraisal, and we need to have a cooperative tenant. Also, if you have an uncooperative tenant who's not planning on leaving, how do you know you're going to be paid your rental income? How do you know that their rental check and their lease is going to cover your loan? Because that's what it is. You're having somebody else basically pay your loan for you.
If you're an investor right now, you should be taking a screenshot of this slide right here. Anytime you're considering purchasing or refinancing a rental loan, these are the things that you should be looking at. Obviously, we'll go into more detail in a lot of these categories, but you should be definitely taking a screenshot or putting down some good notes on all these points that David just brought up.
So now credit boxes. I promised we were getting here. So the different credit boxes, the credit boxes differ between the rental purchase, the rate and term refinance, and the cash out refinance. So you can see the boxes right here. Matt was talking about screenshotting. Let's just look at this right here. 740 plus mid FICO score. You're going to be able to qualify for up to 80% LTV. Doesn't mean you're going to get there because of the different DSCR requirements that we're going to have, but at least you know that you're able to get up there based on your credit score. From a 700 mid FICO to a 739, we could go up to 75% LTV. From a 680 to a 699, we could go up to 70% LTV. And from a 660, which is the lowest possible mid score that we can lend on, we cannot lend lower than 660 to 679. We could go up to 65% LTV. So even if a person has incredible experience, has done 1,000 deals in the last couple of years, credit is still going to be a very important part in how we grade the maximum LTV allowable. So this is on the purchase side.
Yep. So they say cash is king, and I do believe that, but credit is just as important. When you're looking at financing options, acquiring lines of credit, credit is going to be so important, but it is not the only thing that it's not the end all be all. There are ways for us to work around it. You can always improve your credit score. You can sometimes bring on other guarantors. David is a specialist and always trying to solve and figure out ways to work around this. But from a high level perspective, it is so incredibly important to make sure that you have a good credit score, because you can see right here, it is definitely merit based. The higher the credit score, the higher the leverage.
Yep. So that's on the purchase side. I want to also go to the rate and term refinance side. Things don't really change here from the rental purchase boxes. The boxes are exactly the same. And just making sure that your credit is there. The one place where it does change is when we go to cash out refinances. For you to maintain and achieve the maximum leverage on a cash out refinance, which is actually 75% LTV, we only need a minimum of a 720 FICO to get you there. So anything from 720 all the way up to, what's the maximum score? 850?
Yep.
Anything from 720 to 850, you're going to be able to at least qualify for 75% LTV. From 700 to 719, you're up to 70%, 680 to 699, 65%, and 660 to 679, up to 60% LTV. Now, the only thing to note of all these LTVs and all these credit boxes, experience can matter. Does it always matter? Not so much. But here, as a first-time investor, can you expect to see these same leverages across the board? The answer, unfortunately, is no. However, we are able to still provide great options just on 5% less than what you see here. So if you're a first-time investor going into a property and you're purchasing, you have a 740 FICO, instead of 80% LTV that you could qualify for, you would qualify for 75% instead. As soon as you get that one deal completed, you're automatically back up to the highest leverage possible for your credit. So we're going to look at some samples now. Different term loans.
Yeah, I was just going to say, so I think a lot of this is making this relatable. So if myself, I have a rental property, we're going to go through a couple sample loans that I brought to you, David. And, if I were in any of our investors' shoes, we'll walk through what it would potentially look like if I brought these opportunities to you.
Awesome. Yeah. So in each scenario, we're actually going to look at the same thing. We're going to look at a $420,000 purchase price on a 30-year term loan on a 2-family residential. The only thing that we're going to be changing over here is going to be the loan amount, the LTV, and the interest rate. And we could look at possible reasons that will change as we move forward. So on this first scenario, scenario A, we're going to be looking at an 80% LTV at a interest rate of 7.75%, assuming a 5-year 54321 prepayment penalty. And that 5-year prepayment penalty, just to backtrack a little bit, is going to get you the best possible rate for this scenario. So first thing we look at, the rental income. Rental income, it's going to be $4,000 a month. The monthly taxes and insurance combined $700 a month, $600 for taxes, $1,000 for insurance. The estimated principal and interest payments based off of, I'm going to go back, the $336,000 loan amount at the 7.75 interest rate over 30 years. Your principal interest payment would come to $2,407 and change. We add all those numbers together, and that's going to be our total PITI, our principal, interest, taxes, and insurance. So now this is where the fun begins. The easiest way to calculate what your cash flow is and your DSCR is. You essentially take this top number, $4,000, and you divide it by your bottom number, the total PITI, $3,107.15. And what is that going to do? That is going to tell us the cash flow ratio. So that DSCR, that cash flow ratio, is 1.287, meaning that you're about to get around 29% cash flow over your expenses. What kind of deal is this?
That is a very good deal, it looks like to me.
It's a good deal. All right, I'd be very happy with this. Now, sample loan B. We're going to reduce the LTV, right? And maybe we're going to reduce the LTV because you say 7.75% is way too high for me. Right? I want another quarter. I want 25 basis points off. And so to get you that 25 basis point reduction, maybe we're going to decrease the LTV by 10%. But here's the thing. Rental comps come back and our market rental income instead of $4,000 is now $3,100. Monthly taxes and insurance stay the same, but our principal and interest payment, which was previously at 80%, was 7.75. Now at 70% at 7.5. Now is $2,106.25. Now your total PITI is $2,806.25. So maybe the rental comps came back lower. You weren't able to rent it for as much money as you thought it was, but now your monthly PITI is lower. With the monthly income over that monthly pity, is this a good enough deal for us to fund?
We're going to find out right now.
So the DSCR is our minimum of 1.1, meaning we have 10% cash flow. I would say this is an okay deal.
Now, I would say big takeaways here is somebody looking for a lower rate, which was because of the lower rate, we had to go a little bit with the lower LTV. The kicker in a deal like this is that the monthly income is a little bit lower than the previous loan. So, when we look at it, it's not truly apples to apples, but if you did find that the rental income was going to be a little bit less, obviously that's definitely going to affect, even though you're getting a lower rate, your cash flow is not going to be as fruitful in this type of a deal, but it does still qualify. Now for DSCR, what's the lowest that we can go on a DSCR loan, high level?
Lowest loan amount or lowest DSCR?
Lowest DSCR. So we're talking about cash flow. Like if an investor came and total expenses, principal, interest, taxes, insurance was $3,000, and they maybe were making only $3,000. Do we do potentially 100% a 1.0 DSCR? What is our DSCR ranges?
So our DSCR minimum is actually 1.1. We have to see 10% cash flow on a 30-year fixed rate mortgage.
So that's very important. If you're an investor, your property has to cash flow. And that's important. Sometimes we're used as a second set of eyes for your deals, whether it's a short-term construction value add, maybe it's a rental property. We're going to be looking at these loans from an institutional type level. And if they don't qualify at an institutional level, which means, does this loan perform? Is this asset performing in a positive cash flowing manner? Then we're probably not going to be able to fund it. And, so that's why it's always good. It's not the end all be all. If you had to go somewhere else, get it privately funded, whatever the case is. But from our perspective, we always need it to be positively cash flowing, and the minimum DSCR is 1.1.
So that being said, we have the final scenario, right? We're still going to keep a 70% LTV, but let's say rates have actually gone up. Let's say the time that you took or the time that we took, we had a sudden bump in rates, and now we're at 7.85%. We still have monthly income there, but it's $100 less. Instead of $3,100, it's now $3,000. Taxes and insurance will stay the same. Our new principal and interest is $2,106. It's actually not very different from the previous one at 70% at 7.5%. The big thing is that your monthly income is now lower. So with that lower monthly income and PITI staying around the same, we have a DSCR of 1.06, meaning that there's 6% cash flow. Based off that 1.1 minimum, what are we going to do here, Matt?
Well, I was going to punt it back to you, and I was going to ask you, how would you, if I were an investor and if my DSCR is coming in at 1.06, is this a dead deal for me, or is there anything I can do to still make this work?
Yeah, so there's a couple options here. Obviously, you're in control here. You're going to be the one who's making the final decision. All we're here to do is help provide guidance and have the capital for you when you are ready to close. Now, that being said, there are a couple options that I would say consider. Maybe go back to your insurance agent, see if you could find a cheaper plan. I know I spoke earlier about finding something that's effective, but you could always try to get your insurance down. Another thing that you might not be willing to do, but is always going to be an option, is decrease your LTV. I know we went from 80 to 70 earlier. We're at 70% LTV right now, but maybe if you considered going to 65% LTV, bringing a little bit more cash to closing for a property that you truly believe in. I know we like to take emotion out of this, but if you look at a property, you look at the demographics of the area and the geographic region, you could say, well, I see this property going up in value over the next couple of years. And even if I could take in maybe a little bit lesser cash flow, I could see the valuation of the property skyrocketing. So this could be a good long-term investment. Remember here, this is not a bridge. This is not a short-term loan. This is something that you're trying to get a property in here that you're going to see appreciate over the years, or at least give you steady cash flow over the years. So maybe going down to 65% LTV, getting a little bit lower of a rate because of it, could have that DSCR back above a 1.1 and give you the ability to get into investment property where you might not see returns right away, but can give you a good return, if not a great one, in a couple of years.
So there's a lot to take away from these examples, but the key is, if you have a deal, bring it to us. We'll go through it with you. We have a quote feature on our website and also through other different pages. If you click on the quote, the DSCR rental loan quote, you can put in your information. We can go through it with you like we are now, and just always understand that there are options.
Yeah, awesome. So that is pretty much all I have right here for today. But I just want to leave you guys with some tips that Matt and I and the whole entire team give to everybody whenever they ask us, hey, what is your best advice for being the best type of real estate investor I could be? So Matt, building your team. You have been in Alpha for how long now? 8 years?
I'm on 7 years, going on 8.
Going on 8. So Matt got me into Alpha, and he brought other amazing people into Alpha. And we're building our team internally. But that's not exactly what I'm talking about. Because what Matt has showed me and what the team has showed me is that our network really is our net worth. Keep on building your team, build your relationships, reach out to people you wouldn't normally speak to, find your insurance buddy, find your title company, whatever you need to or whatever you don't even think you need to be successful. There's always a way that you could help. There's a way that we could help. And just building that relationship base is so important.
And also getting pre-approved. So David, Priscilla, a lot of our team members, as you get pre-approved, we can also help guide you. If we notice that maybe there's a missing piece to your puzzle, we can find and isolate that. And maybe we can help provide you with some of our resources, trusted, vetted resources that we know that have been in the space, that work with us, and we can introduce you to them. So the key is always people always say, if you want to be successful, you go find and seek out those very successful people and figure out how they're doing what they're doing, or see who they're spending their time with, because success is not a mystery. Usually success, we're going to talk about taking action. It's usually patience, it's grit, it's surrounding yourself with good people, it's knowing your numbers, it's always having that growth mindset, not having a fixed mindset. So putting yourself in a good position, being proactive and not reactive. Make sure you get yourself pre-approved, and you can have David, myself, team members kind of help guide you. So building your team is very, very critical.
Yeah. And then I think you really just covered everything else in there. And I just want to leave us with this. If you guys have any questions, you want to get some feedback on what we're doing, you can email us info@alphafunding.com. Reach out to our company line, 908-900-4894. You could also visit our website, alphafunding.com. You could also go to alphagatorfunding.com as well.
Yeah. So we look forward to hopefully talking to you. If you have any follow-up questions, throw it into the comment section below, or reach out to us directly. And we hopefully look forward to working with you on your next deal.
Yeah. Awesome, guys. Thank you so much for your time, Matt. Thank you so much for having me on. Hope you guys all have a great day, and I do look forward to working with you soon.
Thank you. Thank you. Have a great day, everyone.